Hello and welcome to the Harwood Report for November 13th, 2017, presented by Trade Academy. I am your host and the founder of Trade Academy, Keith Harwood. Standard disclosures: all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. These are things that I am looking at in the market. They are not intended as a recommendation of a certain trade by any means. Do your own due diligence before entering into any trades. This is just how I am approaching the markets and how I am looking at them. So you take this as an educational and informational update as opposed to any sort of trade recommendation. Same highlights as I've been doing. I'll look over the equity indices. I'll talk a little bit about TLT, especially since Friday had such a whippy move there. And then I want to talk about precious metals, standard dollar yen, what's going on in gold, miners and silver, and then finally going back to oil again. Oil has been a very interesting trade. It's had a great run. It's been consolidating a little bit here, and I want to look at how to approach it given what's going on today in that market. So with that, let's go straight to fear and greed. This is the first thing I always look at with regards to the equity markets as my indicator for when things are in an incredibly overbought or oversold level. When fear gets down to like 20, it's usually a good point to say that long, we're going to get a bounce. A lot of times when this gets up to 85, 90, it's at least a consolidation, if not a pullback. Right now, 59, that's sort of that trendless market level. You can dive into what's causing it to not be necessarily greed. Junk bond demand has been in this fear point. Stock price strength. New stocks aren't making new 52-week highs right now. People are kind of selling into rallies. So there's a little bit of stuff here that makes me think, okay, well, maybe the market just chops. But if we look at the charts, that's obviously the next key for me. Start with the S&Ps. Last 3 days have been a little bit scary after making a new all-time high. Got that pullback. But it was just to the 20-day moving average. And few times we've pulled back to the 20-day moving average over the last couple of months. That's provided nice support for a rally to a new all-time high. Pull back to 20-day moving average, new all-time high. Pull back to a 20-day moving average and already bounced today. So for me, I am still leaning on the bull side, still looking for the market to go higher, but not necessarily explode higher, obviously. Sure, maybe we can see this market move towards 260 over the next 2 to 3 weeks. And as long as we hold this 20-day moving average, I'm going to be playing this with a little bit of a long lean. A move to 260 is not that much, so I can't really play this with long outright options. I'll structure some other stuff for the premium newsletter, guys, and show you how I'm approaching that, given that I don't want to play with long outright options, especially since volatility's come up a little bit. I mean, we've seen VXX. Volatility, it's harder to see there. Let's do it with the actual VIX ETF. So, volatility is not 9%, it's up to 11.5%. It's not necessarily a spot where I want to be long a bunch of outright options if I think the market's just going to grind higher. This is a trade where if I want to be long premium, it's because I expect the market to pull back further and actually break below the 20-day moving average and see volatility increase, et cetera, et cetera. So right now, I'm not looking at long outright options in general on the equity market indices. Let's go to the Qs. That's been the best performer. It only pulled back to the 10-day moving average. This right now is the sector that is getting a lot of the love, and it's actually the sector that I have kind of the least confidence in. So in spite of the fact that it is showing relative strength, when I see what's been going on in the small caps, they have pulled back so much relative to NASDAQ that this is where I expect to see a greater likelihood of a spike type move. This is the only place I see my possibility of going into long outright options, because I could see this trying to catch back up to the Qs. The dollar spread between IWM and QQQ is about $7. It's been as low as 0 recently. So, I mean, that just gives a sense of what's been going on with the sector rotation here. People or investors have been dominantly investing into the tech names. We look back at Amazon and Facebook and Google and Apple earnings. They were all good, and that kind of gave another little bit up to tech. But when tech gets this far ahead of the small caps, it is hard to allocate my bullish bias into that sector. Finally, the Dow Jones. I've talked about this before. It's S&Ps. You see that, it was above the 10-day moving average, 3 straight days between the 10 and the 20-day moving average, bounced off the 20-day moving average. It's doing the same damn thing right now. So I'm not at all interested in doing anything in the Dow Jones because the markets aren't as liquid and tight as you can get in the S&Ps. So if I can just execute my trade plan in the S&Ps where there's no other edge in the Dow Jones, why wouldn't I do that? Let's look at something that's been a little more interesting though, and that's TLT. So yields have been falling. And then at the end of last week, yields finally started coming up here. We know that interest rates are going to be hiked in December. It's almost a certainty at this point. And yet, yields just can't seem to firm all that much. People were talking a lot about the 210 spread being an indicator that maybe we're heading into a recession, which, it's everybody's looking for an early indicator. And eventually one of those early indicators will be right. But people have been looking for early indicators for the last 8 years. And it's just not working right now. So I'm not particularly concerned about early indicators. I want to see those indicators actually trigger, because otherwise you're basically just looking for a reason to be short this market, and it's not working. TLT, I think, is an example of a reason why the market actually can continue to firm. If rates rise, there's that concern that, I can get yield here instead of getting yield from utilities. That's fine, but that doesn't mean there's not other sectors that can benefit from a rising rate environment. Financials, for example, which have been getting hit the last couple of weeks, last week and a half, off of this rising TLT, falling yield situation. This could get some money flow if TLT continues weak. And when TLT continues weak, we often see the dollar strong. The dollar had been a little bit choppy, and it actually fell on Friday in spite of the bearish action in TLT, but I expect to see that continue firm again. And that's what gets us into our gold concepts. Dollar yen has been chopping still, but it's been generally holding the 20-day moving average. As long as it holds that 20-day moving average, I have to have a little bit of a bearish bias in gold. In particular, seeing what we saw in TLT and gold and silver on Friday, it looks to me like this market doesn't want to break the dollar against the yen. It wants to see dollar yen firm, and that's going to give me a bearish bias in gold and silver in particular. The gold miners as well, but the correlation is a lot stronger in the actual outright metals. That said, if this 20-day moving average finally fails, and we're looking for a move down to 112, and that's going to put a couple of bucks into gold pretty quickly. Because GLD is trading up here at 124. The last time dollar yen tested the 200-day moving average, and this is the 200 and the 100 and everything else. So there's a lot there. If this moving average, if the 20-day cannot hold today, tomorrow, I think we're going to see gold up, GLD up $3 to $4. And if it does hold, GLD should go back towards lows. And so that's what I'm looking at right now. GLD back towards 120. A little bit of a slow grind to 120, or a potential for a spike to 124. Slow grind to 120. Let's look at the way that I would trade that as a result. Let's minimize this. So GLD vol is not particularly expensive, but it's not as cheap as it was. And generally in a bearish market environment for gold, vol tends to come down. So I wouldn't be surprised to see vol back towards 9.5% to 9%. If I look at the term structure, you can see that there's a little bit of a benefit to going long some options, maybe in December 8th versus the 24th. Realized vol has been closer to 8%, so I don't need to be long gamma. I don't need to own short-term options. So my first idea really here is looking at these December 8th 120 puts for 61 cents against the November 24th 120 puts for 29 cents. So if I was going to create that setup, it's just simply short these and long these. It's a 32-cent spread. It pays off really well for that move back towards grinding down towards 120. So that's my first real way I'm looking to play this, and that's generally because GLD I think is the purest way to play this move right now on the downside. If I look at SLV, it's a little bit choppier. It could move down towards 15.5, but I get fewer strikes. And when I'm looking for a move towards, say, 15.5 in SLV, I can maybe try to play that with some outright options, but I'm going to be better off playing any sort of spread in GLD. And as we all know, GDX and GDXJ, they just both look a lot weaker than the precious metals themselves. So maybe there's a play there, except for the fact that now that volatility is starting to firm. Still cheap relative to longer term history. 28% is very cheap relative to even the last 6 months where we were looking at vol in the 40s for GDXJ. But in a bearish environment, I'm not as excited about that. This is more for the bullish environment. So when I see a bullish signal in gold, I want to look for something here, maybe into January, get some cheaper vol. I get that this is 28 and this is 29, but I don't want to play for really short-dated options in this because realized volatility has been 17 to 18%. So when that trend starts to flip, if and when that trend starts to flip in dollar yen, and people start allocating capital to the precious metals themselves a little more aggressively, that's where I'm going to look at the gold miners and the junior gold miners on the call side. So the idea for me right now, let's say if I was going to go for it with GDX, because this is an easier one for me to do, vol 22.3% here. You can see that the low is around 21. Could easily get back towards 29. I can go out to December 29th and look at some of these 24 calls. They're only 22 cents. They're very cheap. They give you some probability, and 24 in GDX. Let's just look at that on the chart. It's only right here. On a retest of the 200-day moving average in dollar yen, on that break, I expect to see GDX back up to 24 with a vol bid. And that would be how that could then generate some potential for me to get some good returns. So that's how I'm looking at it for GDX. Outright calls in GDX, if and when dollar yen starts to break. It's firming a little bit more as we speak. And a put calendar in GLD if this continues to firm. And in particular, if this gets back above the 10-day moving average, which is very tight to here. You can see the 10-day moving average is 113.82. If we get back above that, that tells you there's a little bit less concern about risk. Risk on is the play. And people will start reducing their gold exposure. You can see on the MACD, this looks a little bit bearish in the short term on the daily, but it's really just been a chop here. And as we get towards the upper end of these ranges, that should start putting some pressure on gold. And on the lower end, there's a little bit of fear in the market. But until we hold and close below this 20-day moving average, I'm not too concerned yet. So it's got to be on a closing basis. So that's how I'm looking at the precious metals right now. Let's go over to oil. So oil has had a really nice run. I think if you looked at this without anything else, you could just say, obviously, we're just in a consolidation period. Small pullback from highs. There is absolutely no reason for me to say I want to be aggressively short oil. Sure, maybe the 10-day moving average doesn't hold and we pull back towards the 20-day moving average. So it's a 3% downside. Until this turns into either a breakout to the upside or a break below the 10-day moving average, there's nothing crazy to trade here. And in particular, we know that the miners, or sorry, the oil drillers and oil companies, they've tended to perform a little worse than oil, just like we've seen in gold. So this is already testing the 10-day moving average. Okay, great. XLE could pull back to 68.5 if oil doesn't hold. I'm not going to look to play for that break. I'm going to wait. If oil doesn't hold the 10-day moving average, I'll wait till the pullback to the 20-day moving average, and if it holds there, then I can look back at bullish plays in XLE or OIH. And otherwise, if it continues to firm, or XLE breaks out of this sort of, kind of flag type pattern here, maybe a move back above 70, I can look for some call structures in XLE. OIH looks very similar, but with a little bit more weakness because that's the way that OIH tends to operate. It got a little bit better bid into the last part of the rally, and now it's getting a little bit more weakness into the first part of the dip. Same idea, I'd be looking at call calendars at OIH, but the volatility isn't actually as attractive to me in OIH right now, given what's going on in the market. So this is, sort of the last thing I'm looking at here in terms of trades for this video, and it's the calendars here because of the way that the volatility, the term structure looks. So when I look at the volatility, it's come up quite a bit. It's 17%. That's still cheap, but on a 1-year basis, the high is really about 19%, 20%. Realized volatility has been anywhere between 9 and 13%, depending upon your time frame. There's no reason for me to be long gamma. I don't want to pay theta, especially if we're in this consolidation kind of chop period. But what I can see is that I can buy some 16.5% vol if I go out to January of 18. I can buy even lower if I go on the call side. So I really like, say, the 72s. I can buy those for 15.2%. It's a pretty decent level. And if I go a little bit shorter here, you can see that December is bid relative to January. You can sell these 15.8%. So it's a little minor thing, but I can get a little bit of a vol edge where I'm buying volatility, 0.75% cheaper in January than what I'm selling in December. It's not great, but if the market doesn't take off, if it just grinds higher, this can perform really well. And if the market pulls back, this doesn't get hit all that much because it's a calendar, and so there's not a huge delta to it. It's really all about just collecting a little bit of theta while I wait for the direction to be determined. And if we pull back and then firm, this still plays. If we just slowly grind higher, this still plays. And then on a move above 70, I can look at some shorter dated options, maybe into next week, just because it's getting so cheap because of Thanksgiving. But until then, this is more of a call calendar play for me. So look at the Jan D72 call calendar around 38 cents as a way to play my bias that this market's probably going to grind higher. So that's really it for this week. So, for me, a lot of the market action is telling me that there's not a lot of explosive potential for many of these sectors. We're going into a holiday week next week. I don't want to pay a lot of theta in general, but what I can look for is a change in the marketplace that drives a more bullish or more bearish environment. In the meanwhile, I'll be looking for more consolidation drift higher in S&Ps and the small caps, NASDAQ as well. Small caps maybe have a little bit more potential for a spike just because they've underperformed so much relative to NASDAQ. Bonds probably just drift lower to me. It seems like that's what the market wanted to tell us on Friday and even today where they came up and now they're drifting again. Gold looks bearish off of the dollar-yen move, so I'm looking for a bearish play in GLD via calendar since the volatility hasn't been very high. But if that trend changes, I'll look at calls in GDX. And again, in oil, I'm looking for a call calendar in XLE because the overall trend is higher and we're just doing a little bit of a pullback here. Pullbacks don't necessarily look bearish to me until we start to breach some key levels, and we haven't breached any key levels. So as a way to play a strategy where I can buy a dip, I can buy a call calendar and have some upside in case the market grinds higher, or if the market sits where it is, and if it pulls back, I'm naturally looking then to potentially look for a way to buy the dip without putting out a lot of risk, and that's a great way for me to play a call calendar in XLE. As a reminder, obviously this is a free video. I do a premium newsletter. I'll be posting that on my website here in a couple of hours that talks through more of what I've talked about here. It'll go through some more explosive option plays in S&Ps, small caps, NASDAQ, some of the other plays I'm looking at in the metals and in the and in oil. I'm really expanding upon what you guys have seen here. So I gave a couple of more nuanced trades this week, and that's generally what I get into a lot more in the newsletters, those ways to get nuanced trades that still have ways to, potentially double or triple money if things go perfectly, without having as much risk as, just being long the underlying ETF. The first month, so there's no real risk for anybody that signs up. If you don't like it, cancel. If you like it, $49 a month. That's actually very cheap relative to the amount of content I'm putting out, but I'm happy to put that $9 a month in order to capture bigger audience so that we can build the audience and build the community. So I'd urge you guys to give it a shot. There's no real risk to you. Take the free offer and see how it goes. You can always contact me, Keith@tradeacademy.co. Call me at 312-600-8004 and follow me on Twitter. Email is usually the best way to get a hold of me if you have any questions or comments. Thanks for watching, and soon.